Welcome to Mark Arnold's Finance. Of course, my thumbnail gave it away. I sold out of Ally Financial, but I'm going to tell you exactly why, so you definitely want to stay tuned. And we're just going to jump right into everything Ally. Of course, they just reported earnings, and over the last year and a half, investors were worried that its automotive-heavy loan portfolio would be hard hit by the macroeconomic trends, but after this earnings beat, it is proving to be holding up much better than expected. And as a result, the stock has surged over 20% today. That is a massive gain. And let's look at its daily chart. Of course, we'll see it is up over 20%. But if we take that out 5 years, we'll see that its performance has been lackluster. It's only up 3.49%. And from its all-time highs, it's down 43.15%. And that's including this 20% bounce. So if we take that out, it was closer to a 60% decline. So not very good, but of course, a lot of investors really focus on its dividend. A lot of dividend growth investors love this stock because it pays out a 4.58% yield. It only has a 20% payout ratio, and it grows that dividend higher than the market median on average. But of course, you have to look at more than just the dividend. This company, it was founded a century ago as the lending arm of General Motors, which is why it's heavy in those auto loans. And the auto loans still make up a significant portion of Ally's loan book. That became a cause for investor concern last year in 2022 as rising interest rates and falling used car values increased the level of risk on Ally's balance sheet. But let's go into the earnings, and you'll see here with my very neat and tidy handwriting there, I'm going to compare it to the analyst estimates. So the company did beat their earnings, and they put some of the fears to rest for investors. Ally earned $1.08 per share on revenue of $2.2 billion, beating analyst expectations for $1 per share in earnings on $2.05 billion in sales. Ally appears to be doing a good job pricing its loans in a rising interest rate environment. It generated an estimated retail auto originated yield of 9.57% in the quarter, up 260 basis points year over year. Ally was also helped by its insurance operations, which generated pre-tax income of $101 million in the quarter compared to a $30 million loss in the prior quarter, in third quarter. So it went from a loss to an income on these insurance operations. Now, the CEO, Jeffrey Brown, had some things to say about this quarterly earnings. He said in 2022, Ally continued its strategic evolution while navigating a fluid macroeconomic environment. The optimization across our businesses was evident in our ability to generate record net interest margin and total revenue. We continued to expand our customer base, now 11 million strong, as our customer-centric products continue to resonate in the market. And as far as that interest margin goes, of course, we've been seeing the Fed increasing those interest rates. And once it starts decreasing, though, that's something to keep in mind with Ally. Now, Ally's consumer auto loan originations in the quarter were down year over year to $9.2 billion from $10.9 billion, and the bank provision for credit losses jumped by $376 million to account for the added strain on the consumer. So they're preparing for the worst, and I like to see that. Now, investors do need to be aware, even with this 20% jump, conditions could get worse before they get better, and that's something that I'm keeping in mind, and one of the reasons why I sold. I still think there's some risk this year. Now, the latest results, however, are an indication that Ally is weathering the storm and making steady progress in diversifying its balance sheet. So Ally's mortgage, credit card, and other non-auto loan lending portfolio has grown at a compound annualized rate of 26% since 2014, from $5.4 billion to $33.4 billion. While that lending is not without risk, the overall risk profile of the company is evolving. So it's diversifying outside just auto loans to these other type of loans. So Ally's rocky road could continue into 2023 as mentioned, but for long-term focused investors, it appears the lending remains on the right course. They did have $1.7 billion of share repurchases in 2022, which when a company repurchases its shares, that does help boost its earnings. And this company has healthy capital, reserves, and liquidity levels, so it's well positioned for the evolving environment. So with that said, why did I sell? Well, right here is one of the reasons. If you have not seen my latest video on this quality checklist, I'm going to put the link down in the description. I highly recommend you watch that. I think it's very valuable and will help you become a better investor. So I'm not going to go into it in detail in this video, but I am following this quality checklist to a T with all my investments, all my future purchases. I am staying strict and sticking to this. So I want to go through each item on here with Ally Financial and rate it a 1 through a 10, 10 being the best, 1 being the worst. So we're going to start with solid financials. I rate Ally a 6 out of 10. Obviously, they're doing better than expected. They beat earnings, but their earnings have been on a decline, a downtrend, and I still think there's some solid risk that as investors, we need a few more quarters before we can breathe that sigh of relief, which is why I'm giving it that 6 out of 10. Now, as far as a good management team, I give them an 8 out of 10, so a high ranking, and that's because they do have good financials, they beat expectations, and that means that this company is being managed very well. They have a high customer retention rate of 96%, which is great to see, so they're doing something good there as far as their customers, and as far as employees, I feel like they're being taken care of very well. We'll see here they have all these awards for companies that care, most loved workplaces, top workplaces of 2022, America's best large employers, the best employers for diversity. They offer some great benefits, and I'll tell you, every time I've called this company, their customer service is excellent, which to me, I read that as their employees are happy. So I do think they have a good management team that is making good decisions to help them weather this storm when others thought they would have done worse. Now, as far as brand recognition, I'll give them an 8 out of 10 here, so another high ranking. Now, in their field, I do think they are highly recognized. I see a lot of YouTube videos putting out videos of the best high yield savings accounts, and Ally is always either number 1 or number 2. So they're well known in this space, but it is a crowded field, and that's the reason why I didn't get a 9 or 10 for me. I utilize Ally for some of its services, but I will say there are so many options out there, which knocked it down a few points. But it is in its field currently, I'd say one of the top 2. So next up, we have products and services. It's always good to know what your company does and see how strong these products and services are. So I give them a 6 out of 10 here. I feel they have that high customer retention, which is great. But I do feel customers can easily move and transfer to another platform. It's not hard to do. There's nothing that I feel is sticky enough to keep customers with Ally should things change or they have a better, yield somewhere else that they can get. There's also no subscriptions that I know of. Of course, their loans are kind of like that reoccurring revenue, but a non-loan type subscription service, I don't know of one. If you know of one, let me know. But obviously, there's nothing big enough to be on my radar. I don't think they have that great of an ecosystem. You look at a company like Apple, you buy the phone, you're more likely to buy the watch, the AirPods, maybe Apple Music. They have a good, healthy ecosystem. Where Ally, someone might just put money into the high yield savings account, but they're not going to get a loan from them. They're not going to invest with them. So I don't think they have a strong ecosystem. So that's why I give them a 6 out of 10 here. Now, as far as their moat, I give them average, right in the middle, a 5 out of 10. It is known in its space and it's established with 11 million customers, but it can be disrupted and replicated, I feel, pretty easily. There's a lot of companies out there, as I mentioned, and they're all fighting to get that market share, which leads me to this other point that this company is not a monopoly or duopoly. There's so many other digital banks and financial services out there that this company, to me, has a long ways to go before I would consider it that monopoly where I'd be very solid in feeling safe with this investment. So that's why I give it a 5 out of 10. Now, valuation. Does it have a good valuation right now? Yes, I think it does. And I give it a 7 out of 10 here. I think that the valuation is good. You're getting an undervalued stock, but there is a level of risk here, and I need more of a built-in level of safety. So for me, I would like to see the stock price go much lower in order for me to feel like it's an excellent valuation and me rate it that 8, 9, or 10. And I'll be telling you here in a minute at what price point maybe I'd be willing to buy back in. So let's quickly look at my portfolio performance. I share this with every single video. If you like transparency, honesty, someone who shows the good and bad, this is the channel for you. I feel it's a very beneficial channel. It might not be the most sexiest channel that, promotes stocks that 10x or something like that. I think that's the wrong way to go about it. This is a solid channel. I feel that will help prepare you for that future wealth. And so be sure to subscribe if this is something that interests you. We'll see here my portfolio is down 1.78%. That's almost $900 of unrealized loss. And if you look at the financial sector, it is a little bit more lonely without Ally. Now I only have Bank of America and the ETF FNCL. And so I've been consolidating my portfolio a little bit. I have some plans, so you definitely will want to follow me throughout this next year. But I want to tell you, why did I sell Ally Financial? Well, first of all, that quality checklist, I told you I'm going to be sticking to it, and it did not rank high. I only got 8 rankings out of the 6 items there, and I need more than just 2 items to rank 8 or higher. Also, it has a higher risk than many of the other stocks that I hold. It's riskier than Microsoft, than Amazon, than Cisco, than Bank of America, so on and so forth. So it's one of my more riskier investments, which is why I was okay selling it. Also, one of the main reasons too, and I said this in a few other videos, is I was not patient with this investment. I set a price target for myself to buy in, and that was below $30, and I bought in at $32. I got impatient. I pulled the trigger before I should have, and so I feel like I didn't follow my own rule, and there's another reason why I sold out. Also, some will just focus on the dividend, but I think you need to look at the whole company, which my quality checklist helps do, so I'm sticking true to that quality checklist. And again, I need more 8 or above rankings on that list in order to consider it a very good investment. So that's why I sold. But would I buy again? Absolutely. I do think Ally Financial is a great company, but if it offers a better valuation, that's when I would be buying in. I need that added level of safety for me. So for me, that is at $25 or below. That's where I'd be willing to buy in. My average was about $31. That's where I sold out. I was able to get out at a little bit at a profit. But if it goes back down to $25 or below, I would open another position with Ally. I think it's a great company, and at that point I'd have my added level of safety, and I feel there would be good future upside potential, almost pretty high level of confidence I'd be in the green and make a lot of money with Ally in the future if I can get in at that price point. So I want to tell you, I've done some videos where I shared my bullish thesis on Ally. The one thing as an investor is you cannot be married to a stock. You can't be in love with it, get emotional with it. You are an investor and your goal is to make money. So it's okay if you sell a stock if it doesn't fit your strategy, if something's changed with it. A lot of people think you have to buy and hold forever, and that is not the right way to look at it. You want to be a long-term investor, have a long-term viewpoint, but be open and willing to sometimes recognize when maybe I should take some profits, or maybe this investment doesn't fit my strategy anymore, or I revisited it and it just isn't a strong investment, and it's okay to sell. Just be patient. That's one of my best things of advice. Don't be impulsive. Do your research and stick to your strategies. So with that said, I will be taking those funds from Ally and deploying them somewhere else. So you want to stay tuned because there will be some changes to my portfolio. Again, this channel is to follow me. I want to become wealthy, but also for yourself to grow and become wealthy by listening to somebody that's honest. I'm going to be sharing the good and the bad. And right now I'm sharing something that a lot of people, I don't think they like to share when they sell stocks, more so when they buy stocks. Also, if they've been bullish on something, they're less likely to talk about it if they do sell out. I'm okay. I'm an open book, so that's what we're about here on Mark Arnold's Finance. And with that said, I hope you guys have a great day, and we'll see you very soon. Thank you very much.